Broker IPTV.
Today we're talking with Chip Allen, branch manager of Lakewood Residential Mortgage, a division of Universal Lending. Chip, welcome to the show.
Good to be here, Dan.
All right, obviously what the whole world, not just the U.S., has been talking about is the economy, and mortgage and housing is right in the middle of it. How is this affecting your business?
Well, I'm glad that my office is on the ground floor. I'm not tempted to jump. Things are down quite a bit.
Yeah.
I'm going to be missing a few meals, but that's a good thing. We're seeing some light at the end of the tunnel, and I think things are looking up, but it's going to take a while.
All right, what is the light at the end of the tunnel? What are we seeing?
Money is available, number one. Number two, we're starting to see not only first-time buyers jump in, we're also seeing investor groups grab single-family properties. We saw this a long time ago, 20 years ago. Informed individuals coming in and buying things tends to indicate that the market has bottomed out.
Okay. How do you feel when you hear all this talk over the last month in the media, and a lot of different people have said it, that it's all the fault of the predatory lenders?
Well, there were a lot of predatory lenders. They're no longer a factor. Number one, they don't have the bad products to peddle to people. Number two, government regulation. Regretfully, there's enough of the blame to go around. Not only the predatory lenders, which I wish more of them would go to jail, but government had a big part of it, and we also had irresponsibility and ignorance on the hands of consumers. So everybody's kind of involved.
And then we got the Wall Street piece, which we could talk about for a while. So the state of lending is there's money available, but clearly the guidelines and the game has changed. Can you give us some of that?
Yeah, policy always reflects the worst abuses of the past. We've got rid of a lot of the very bad programs, which we shouldn't have had in the first place. 100% stated income, investor loans with a 600 credit score. That's a toxic mortgage. It's just waiting to blow up. FHA, which I've always been a champion of, is gaining a lot of inroads. It's a good, solid program. They've tightened the requirements up considerably. This is not intrinsically a bad thing. Some of the programs, for example, stated income is pretty much gone. Stated income programs, I don't think are intrinsically bad if we have really good credit, a big down payment, and reserves.
Define sufficient credit.
Sufficient credit. In reference to stated income,
or just full doc. I mean,
full
these
doc.
days, if somebody's coming in and they say, you know, my credit score is not terrible, it's not great, but where does it need to be now with the kind of the new frontier in lending?
If you're in the lower 600s, you're going to be okay FHA. But if you want conventional, you better be 680 and above, and you better have a down payment. Thing to remember, I pretty much think that all of your loans over 90%, most of them are going to have to go FHA. If you're going conventional, you're going to have problems. And you always have to remember, if you go over 80% with a conventional product, you need mortgage insurance. Mm-hmm. So things have tightened up quite a bit. They're taking more of a look, which I don't think is necessarily a bad thing.
Chip, thanks. Great information.
Thank you.
Appreciate it.
Find more real estate videos at brokeriptv.com.